Imagine running a manufacturing business that just loses $2.5 billion in a single quarter.
Right.
You're forced to slash 15% of your entire workforce, and you just took on, what, $6.5 billion in new debt?
Yeah, which is a massive hole to dig.
Exactly. So by all traditional metrics, you would think this company's on the absolute brink of collapse.
You'd assume it's completely doomed.
But then, against all odds, your stock surges to a 52-week high.
It's wild. It is the ultimate paradox in the market right now.
Welcome to the Byte-Size Brief. Today we are putting Intel, that's INTC, completely under the microscope. Let's get into it.
Yeah, we are doing a massive deep dive today because to really understand what is happening under the hood with INTC, you really need a 360-degree view.
Which we have. We pulled a huge stack of sources for this one.
Right. We've got the recent SEC filings, the Q4 2025 earnings data, independent technical research from Hyperframe.
Investology's Sector Atlas in there too.
Yep, and we are even scraping retail and employee sentiment directly from Reddit. So we are looking at this from every possible angle.
And we're doing this because INTC is sitting near that 52-week high of $58.95.
Which is up roughly 38.4% just over the last 6 months alone.
Right. So our mission today, for you listening, is simple but super critical.
We need to figure out the truth here.
Right. We need to determine if this is the start of this legendary manufacturing renaissance under CEO Liputan.
Or if it's just a massive hype bubble that is mathematically waiting to burst.
Exactly. So let's start unraveling that. We have to look at the massive April 2026 catalyst first.
Yeah. The news that sent INTC shares surging, 11.42% in a single trading session?
Over 11% in a day. Just insane.
Because they confirm they are officially joining Elon Musk's TeraFab mega AI chip project.
Teaming up with SpaceX, Tesla, and XAI. Which is wild, just on the face of it. I mean, the stated goal of this TeraFab project is to produce 1 terawatt of annual AI compute.
1 terawatt.
Let's pause on that for a second. 1 terawatt. That is a trillion watts of computing power.
It is a scale that almost defies comprehension, honestly.
Right.
To put that in perspective, you are talking about the kind of raw electrical and processing power required to build next-generation physical AI.
Like actual robotics and citywide autonomous systems, right?
Exactly. And for INTC, being chosen as a primary fabricator for this project is, well, it's the ultimate external validation.
Okay, but hold on, taking a step back here, I have to ask from the perspective of an everyday investor like me.
Sure.
How does that actually affect INTC's stock price? I mean, announcements and partnerships with Elon Musk always generate headlines, but how does this translate to the actual bottom line?
Well, it comes down to proving their entire corporate thesis to the market.
Which is what, exactly?
INTC has essentially bet the entire future of the company on becoming a systems foundry.
Right, building chips for other people.
Exactly. So securing the TeraFab project essentially proves to Wall Street that their U.S.-based manufacturing facilities can actually handle the most demanding, cutting-edge AI workloads on the planet.
So they aren't just making promises anymore.
No. They have the biggest AI player in the world signing a physical contract.
Okay, but fulfilling that contract requires physical facilities.
It does.
And that brings us to a massive and, frankly, terrifying financial move we found in the SEC filings.
The Apollo deal.
Yeah. INTC just executed a $14.2 billion deal to buy back Apollo Global Management's 49% stake in their Fab 34 facility in Ireland.
Right. So a few years ago, they brought in Apollo.
Who is a massive private equity firm.
Yeah, a massive private equity and alternative asset manager. They brought them in to help co-fund the construction of this mega factory.
Got it.
But now INTC wants full, unadulterated control of that specific capacity.
Wait, let me push back on this. They are bleeding cash right now.
Very true.
You just said their Foundry segment, like the manufacturing side of the business, posted a $2.51 billion operating deficit in Q4 2025 alone.
Yes, a massive deficit.
So they go and borrow $6.5 billion in new debt to buy more of a factory.
I know how it sounds.
It sounds like a terrible idea.
Yeah.
Why would you take on more debt when you are already losing billions?
I see why you'd think that, and it is undeniably a high-wire act for management. But you have to look at the mechanics of why Apollo wanted out
Okay.
and why INTC wanted them out. Private equity firms like Apollo, they want predictable, steady return.
Right. They aren't venture capitalists.
Exactly. They don't want to be strapped to a highly volatile turnaround story that might, miss a product cycle.
Makes sense.
On the flip side, CEO Liputan knows that if this turnaround works, especially with these new TeraFab capacity demand sharing, 49% of the profits from that Irish factory would be a massive drag on their long-term earnings.
Oh, I see. So taking on the debt now gives INTC 100% of the upside later, but it also gives them 100% of the risk.
100%.
Which begs the question,
Yeah.
what on earth are they manufacturing inside these facilities that makes them so confident they can pay that $6.5 billion debt back?
Right.
And that brings us to the commercial launch of the Core Ultra Series 3.
Code-named Panther Lake. This is where the engineering rubber meets the road.
Okay, break this down for us. Why is Panther Lake so important?
It's incredibly important because it is the very first commercial product built entirely on their new 18A process node.
And crucially for their geopolitical narrative, this node is entirely manufactured on U.S. soil.
Exactly. The 18A node is the technological foundation of their turnaround. We really need to understand the two massive innovations it utilizes.
RibbonFET and PowerVia.
Yes.
Okay, let's break those down without needing an electrical engineering degree. Let's start with RibbonFET. What is the actual mechanism here?
So RibbonFET is INTC's proprietary version of a gate-all-around transistor. For the last decade, the industry used a design called FinFET, where the conductive channel looked like a little 3D fin protruding upwards.
Like a shark fin.
Kind of, yeah. But as transistors shrank to microscopic, almost atomic levels, those fins started leaking electrons.
Leaking.
Yeah, they simply couldn't turn the electrical current off completely.
So kind of like a leaky faucet that you can't quite twist entirely shut.
That's a perfect way to look at it. And in a chip with billions of transistors, millions of leaky faucets mean massive overheating.
And terrible battery life for the user.
Exactly. RibbonFET solves this by wrapping the control gate entirely around all four sides of the conductive channel, like a ribbon.
Ah, hence the name.
Right. It completely seals off the electron flow when it needs to, which gives them incredibly fast switching speeds and drastic power savings.
That makes perfect sense. And then there is PowerVia, which is their term for backside power delivery.
Right. Historically, when manufacturing a chip, both the microscopic power wires that deliver the electricity and the data signal wires that transmit the information were crammed onto the very top layer of the silicon.
Let me guess, combining massive amounts of electrical current right next to sensitive data signals causes interference.
Massive interference. It creates electromagnetic noise, and it physically clogs up the routing pathways.
So what does PowerVia do?
PowerVia literally flips the script. It moves all the power delivery wiring to the back of the silicon wafer.
Leaving the front entirely dedicated to high-speed data signals.
Exactly.
So basically, it's kind of like rewiring an old house so that the heavy, high-voltage power lines are hidden down in the basement.
Yes.
Entirely separated from the delicate fiber optic internet cables running through the walls upstairs.
That is a brilliant analogy, and the result of that separation is profound for the chip.
It optimizes signal transmission.
Yes, and dramatically improves energy efficiency, which is the absolute holy grail for AI computing right now.
And INTC claims this 18A node is up to 25% faster, or 36% more efficient than their previous generation.
But the most important metric here isn't just speed.
Right. According to the Investology report, the metric that determines if INTC lives or dies is yield.
Yield is everything.
And the report notes that 18A yields are currently clearing the 60% threshold. Walk us through why 60% is the magic number here.
It comes down to the brutal economics of wafer fabrication. A silicon wafer costs the exact same amount of money and time to bake, regardless of whether the chips printed on it actually work.
Okay.
If your yield is 40%, it means you have to physically throw away 60% of the silicon you just spent months processing.
Which means the cost of the surviving chips is astronomically high. You'd have to sell them at a massive loss just to get them out the door.
Precisely. Hitting 60% yield is that critical mathematical tipping point.
The break-even point.
Right, where the cost per viable chip drops low enough to actually turn a profit when selling to consumers and data centers.
Wow.
If they couldn't hit 60%, Panther Lake wouldn't just be a disappointment, it would be a complete financial disaster. Clearing that hurdle proves the manufacturing process works at scale.
Okay, so the underlying tech is sound, and the yields are viable. But let's transition to the financials.
Let's do it.
Okay, so compared to last quarter, what actually moved the needle here on the balance sheet?
Well, if we look at the Q4 2025 financials, the absolute standout was the Data Center and AI Group, or DCAI.
Okay, how did they do?
They hit $4.7 billion in revenue for the quarter. That is up 9% year over year and up 15% sequentially from the third quarter.
Okay, so a 15% jump from Q3 to Q4.
Yes. It shows that enterprise customers are actively buying their Xeon 6 server chips to orchestrate AI workloads.
And zooming out, overall revenue for 2025 held flat at $52.9 billion.
Right.
Now, flat isn't usually a word that excites Wall Street,
Yeah.
But when you are trying to stop a multi-year bleed, flat is a massive victory.
It shows stabilization.
Plus, they are aggressively leaning out the operation. They executed a brutal restructuring plan, cutting 15% of the workforce.
Yeah, targeting 75,000 employees. It is a severe cut.
Very severe.
And if you look at the Reddit chatter we scraped, you can see the human toll of this. Engineers are on there lamenting the loss of daily free fruit, the subsidized coffee, the commuter shuttles.
Yeah, a turnaround is getting deeply serious when a Silicon Valley tech giant takes away the free cold brew.
It's brutal for the culture, absolutely.
But from a purely mathematical standpoint, it is working to lower operating expenses. We also saw that asset impairments dropped massively.
They did.
From $3.3 billion in 2024 down to just $950 million this past quarter.
Yes, and to clarify for you listeners, an asset impairment in this context usually means the company is writing off the value of older, obsolete factory equipment.
You make room for new stuff.
Exactly, to make room for new, cutting-edge, extreme ultraviolet lithography machines.
Okay, so a drop to $950 million means what?
It means they have largely finished clearing out the dead weight from their legacy factories.
That's a good sign. Add in the fact that they just sold a 51% stake in Altera for a $5.6 billion pre-tax gain, and they have successfully injected a massive amount of cash into the business.
They have. But we can't just look at the rearview mirror here.
Right.
The Q1 2026 forward guidance they provided is, well, it's grim.
Very grim. They are projecting revenue to come in somewhere between $11.7 billion and $12.7 billion.
And they are projecting negative full-year GAAP earnings per share of negative 6 cents.
Right. So the bottom line is still negative because those multi-billion-dollar Foundry investments are dragging down the margins.
Exactly.
And here's where I am genuinely confused, and I need you to explain this to me.
Sure.
Despite negative earnings and grim guidance, INTC just hiked their CPU prices by 10 to 15% across the board.
They did.
If you are bleeding cash and facing fierce competition, raising prices sounds like corporate suicide. Are they just trying to artificially pad their revenue numbers for the next quarter?
It looks that way on the surface, honestly, but the reality is a severe wafer fabrication supply constraint.
A supply constraint.
Yeah. The global AI build-out is so massive right now that demand for their older Intel 3 and Intel 7 node chips is vastly outstripping their physical capacity to print them.
Wait, really? So they have pricing power simply because there isn't enough supply?
Exactly. They can raise prices because their enterprise customers have nowhere else to go in the short term.
Wow.
It highlights the incredible irony of INTC's current situation. Their biggest bottleneck right now isn't a lack of demand for their products, it's a lack of manufacturing capacity to actually fulfill that demand.
That is wild.
Yeah.
But to understand if that pricing power is permanent or just a temporary blip, we really have to benchmark them against the competition.
Definitely.
Let's look at the AI battleground, specifically the NPU war.
So NPU stands for Neural Processing Unit, which is dedicated silicon built strictly to handle AI mathematics efficiently in the background.
Without training your battery.
Exactly. And here, INTC is facing fierce headwinds. QCOM's new Snapdragon X2 Plus chip is dominating the dedicated laptop AI space with an 80 TOPS NPU.
And TOPS stands for trillions of operations per second.
Correct.
Okay, so QCOM is hitting 80 TOPS. Where does INTC's Panther Lake sit?
INTC's standalone NPU5 only hits 50 TOPS.
Oh.
So if a customer just wants background AI tasks like blurring their background on a video call or running lightweight local chatbots, QCOM wins on efficiency.
But hold on, the Investology sector Atlas points out a critical nuance here.
They do.
While QCOM wins on the dedicated NPU, INTC's Panther Lake actually wins heavily on overall graphics.
Right.
They're utilizing their new XE3 architecture, which delivers a massive 180 total platform TOPS when you combine the NPU and the GPU.
That is a vital distinction for real-world applications.
Right. If you are a listener who edits 4K video or runs local AI image generation or does heavy 3D rendering, that 180 total platform TOPS means the difference between waiting 5 minutes for a render versus 5 seconds.
Absolutely. INTC still takes the crown for the heavy lifting.
Okay, so that's consumer laptops.
Right. But if we move from consumer laptops back up to the enterprise data center, INTC just secured a massive validation win.
Tell us about that.
Their Xeon 6 processors were officially selected to serve as the host CPUs in NVIDIA's highly anticipated DGX Rubin NVL8 systems.
Wow. That is a huge stamp of approval. I mean, NVIDIA is the undisputed king of AI hardware right now.
They are.
But looking at the hyperframe research, we can't ignore the wolves at the door.
No, we can't.
AMD is rapidly taking server market share with their incredibly efficient EPYC processors, right?
Yep, and ARM just announced a brand new AGI chip that specifically targets the data center.
Which represents a huge threat.
An existential threat to the legacy by-86 architecture that Intel relies on. I mean, AMD and ARM are relentless right now.
Right, but what does all that actually mean for INTC investors? I mean, does the NVIDIA partnership actually protect them from AMD and ARM?
Well, what the NVIDIA partnership proves is that the classic by-86 ecosystem, which INTC essentially invented, is still absolutely vital for orchestrating complex AI workloads.
Okay, explain how.
Think of it this way. NVIDIA's AI accelerators are the muscle.
Right.
They do the heavy lifting of training the models. But they still need a traditional CPU to act as the brain that feeds them the data, manages the network, and runs the operating system.
NVIDIA chose INTC to be that brain.
Exactly. NVIDIA choosing INTC proves they haven't been written out of the AI infrastructure story just yet.
Okay, so we've covered the tech innovations, the surprisingly resilient financials, and the competitive threats.
We've covered a lot.
But there is a ticking clock hidden deep in the Investology report that I think every listener needs to be acutely aware of.
The Q3 2026 deadline.
Yes.
This is arguably the make-or-break moment for the entire company. We talked a lot about the 18A node launching right now. Right. But in semiconductor manufacturing, you are always living 3 years in the future. Their next generation lifeline is the 14A node.
Okay.
And INTC has publicly stated that if they do not secure a significant paying external customer for the 14A node by the third quarter of 2026,
they might pause or discontinue its development entirely.
Exactly.
So we hear the phrase IDM 2.0 thrown around a lot as corporate jargon, integrated device manufacturing. Historically, INTC only baked their own chips in their own kitchens.
Right.
IDM 2.0 is Lip-Bu Tan's master plan to open their kitchens and bake chips for competitors. If the 14A node is scrapped, what happens to that dream?
It dies.
Just flat out dies.
If 14A is scrapped, INTC won't even be able to manufacture its own future cutting-edge designs.
Oh, wow.
They would have to wave the white flag, abandon the Foundry dream, and rely heavily on TSMC to build their tech.
Which means they would become just another chip designer, indistinguishable from QCOM or AMD.
Exactly. And that profound binary risk perfectly explains the current market sentiment we are seeing.
Because despite the recent 38% stock rally, Wall Street consensus maintains a highly cautious reduce rating on the stock.
Right. And because their current earnings are negative, their forward PE ratio is sitting at a staggering 107.56.
Over 100. That is insane. Investors are paying a massive, eye-watering premium for a turnaround story that has a hard, fast deadline attached to it.
It is the ultimate high-risk, high-reward scenario.
But before we wrap up today's deep dive, there is one final wild card hidden in the recent SEC filings that is buzzing all over Reddit.
Yeah, and it might just change the entire risk calculus.
In 2025, the U.S. government quietly acquired a roughly 10% equity stake in INTC.
It was an $11 billion move, largely executed through the mechanisms of the Chia PS Act and the Secure Enclave program.
Now, it is worth noting that this move actually triggered a shareholder lawsuit regarding how the board handled the equity dilution without a wider vote.
Right, it's definitely messy. But regardless of the ongoing legal drama, we are just reporting the facts of the market here.
And the fact is, the United States government is now a major direct shareholder in the company.
And what that signals to the market is profound.
It means INTC is no longer just a consumer tech company that rises and falls on laptop sales.
They are officially viewed as a critical domestic national security asset.
Right. When a company builds the fundamental silicon required for your nation's defense infrastructure, autonomous drones, and supercomputers,
You do not let that company fail.
you just don't.
That $11 billion government stake fundamentally changes the risk profile. It might just put a permanent floor under the company's valuation.
Acting as a massive safety net no matter what happens with the 14A node deadline.
It is a fascinating dynamic. You have a company taking the biggest technological and financial risks in its 56-year history.
Backed by the deepest pockets on the planet.
Right.
So as you look at your portfolio today, you have to ask yourself a hard question.
Are you betting on a historic, U.S.-led manufacturing renaissance?
Or are you just buying a very expensive, highly leveraged, government-subsidized safety net?
Something for you to chew on as you watch those charts.
All right, listeners, what's your take on the future of INTC? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.